Thank you very much. Appreciate the opportunity to be here. For all of you who wrote me after the last episode, first episode that is, thank you very much for your interest. So I want to thank the foundation for giving me the opportunity to present this class. We're going to do it every week until people get tired of it. I look forward to your feedback. Very important for me to know exactly what you're thinking and exactly what you want to hear. We're going to talk primarily, excuse me, we're going to talk primarily about seasonals, how they're used. We're going to talk about the logic of seasonals. We're going to talk about how to find them, how to use them intellectually as well as pragmatically. Sorry, we're not using the camera the way we should, but we'll try and do better next time. So what are we going to do? Number one, we're going to talk about seasonals and why we study them. Number two, I'm going to give you some definitions. I'm going to look at the long-term record of accuracy for seasonals because the accuracy is really tremendous. In fact, let me see if I can get a better pointer. Just one moment, please. Here we go. 1 second, please. Here we go. So we're going to talk about seasonal charts, seasonal trades, and important. Please give me your feedback. I want to make sure I'm giving you information that you can use, information that's clear and concise. So let's begin. The usual disclaimer right over here, which says, of course, you can lose money trading. The results that are hypothetical are shown. When we do actual real trades, I will tell you when I do them. We're going to try and look at trades from the beginning to the end, but most of all, we're going to operate on two levels. The academic level, namely to show how beautiful seasonality is, what a great concept it is, and secondarily, the pragmatic level, how do we use it for the purpose of investing or trading short-term, intermediate, and long-term. So in terms of my experience has been very lengthy. I've been trading for 52 years, which is a considerable amount of time, during which I've learned a great deal about cycles. My first experience with cycles and seasonals was in the early 1970s when I saw a magazine entitled Cycles, the Foundation for the Study of Cycles official publication. It's been in continuous publication for most of that time since then, but it contains a wealth of information. In fact, in the early summer of 1972, I picked up a copy of the magazine in the library, and the first thing I saw was the 5.5-year cycle in corn prices, which I intended to show today, but not able to use the camera for some reason today. But I will be showing it again. Now, let's talk about introductions. The Foundation for the Study of Cycles, of course, has a wealth of information, and if you are not a member, you really should be. I want to stress, most important of all, I have nothing to sell you. There's no pressure here. I simply want to educate you on a methodology that's been working extremely well for me for many, many years. The important thing is this. Everything I teach you is specific, clear, exact, to the point, and no interpretation. So you'll never hear me talk about politics, about earnings, about the government or anything like that. No conspiracy theories, just pure facts. Let's take a look. The next point, Edward R. Dewey, the so-called father of the Foundation of Studies Cycles. Much of this work has to do with Dewey and what he originally presented in his work. And remember, his book has been reprinted by the Foundation. Definitely worth taking a copy, buying a copy, and keeping it in your library. I want to thank the directors of the Foundation as well. Let me tell you a little bit about myself, in case you don't know anything about me. As I said before, I've been trading for 52 years, and I'm beginning to sound like it as well. But during this period of time, I've learned a great deal. It took me 15 years, that's 5 years, to learn how to trade. And still, I didn't learn it. Why? Because there were very few sources of valid, reliable, specific, objective information. But we are beyond that by now. We have computers, we have the ability to program computers, and of course now we've got artificial intelligence to help us understand and interpret all of this data, which I will show you specifically as the time approaches. Let's go to the next point. Oh, and by the way, I've written 45 books on trading and so forth. Not important. My cycle's epiphany. It was early in the summer of 1972 that I realized there was more to the market than simply putting prices on a chart and drawing trend lines. There was more to the markets than just reversals, key reversals, flags, pennants, and so forth. In fact, I learned that there were so many repetitive patterns, we had to be very specific and objective and focused in finding the patterns that work for us. So my talks will be about seasonality. I'll specifically give you an indication of what seasonality is, in my opinion, so that you can see how to use it. In addition to that, I have good news and I have bad news. The good news, there are many, many indicators that traders can use, many patterns. The bad news, of course, is most patterns don't work. So you have to be very, very careful. Let's go to the next slide. There are many different types of cycles. The cycles that we're going to look at are seasonal cycles, which means they occur within the course of 1 year. So we're not going to look at the bigger picture cycles. We're going to look at the smaller ones. Let me show you what I mean. Example, let's take a look at the price of cotton. This is a long-term chart of cotton prices. As you can see, cyclical lows and cyclical highs. Not symmetrical. Because they're not symmetrical, we can't simply say, sell when you think there's a top, buy when you think there's a bottom. We need to combine cycles with timing. Super, super important. So the first step in what I do is the cycle. In terms of seasonals, the first step will be find the seasonals. So we can work with the cycle, we can work with the seasonal. They are not mutually exclusive. They work together, sometimes in uncanny ways. So as an example, right now, the long-term cycle, which is measured in years and fractions of years, is saying cotton prices are due to bottom. But a cycle bottom, as projected, is an expectation, not a realization. This cycle needs a trigger. So we need to wait for a timing trigger before we buy cotton. In this case, because it's a long-term cycle, it would be an investment as opposed to a trade. Let's go to the next slide. A cycle in the Japanese yen. Those of you who get the foundation newsletter will recall that about a month ago, I wrote an article talking about the bottom that was coming in the yen. You can see the bottom was late. So we were waiting for the timing trigger. The timing trigger came, the article was written, and the yen has moved considerably higher since then because as you can see, this is an older chart. It does not show the big move up that we've seen in yen versus US dollar in the last few months. Let's go to the next slide. And again, I'm showing you cycles here. Sometimes, as a member of the foundation, you should know there are cycles with harmonics. Example, this is the approximate 8-year cycle in the British pound versus US dollar, showing very regular 8-year lows approximately. Within that 8-year cycle, we have 1, 2, 3, 4 shorter cycles, which can also be traded for intermediate term. But again, I'm not talking about that right now, specifically in terms of methodology. The presentation for this report and this series will be strictly seasonals, which we will get to very shortly. So again, if we look at the chart, bottom right of the chart, between late 2024 and early 2025, both cycles are projected to bottom. The forecast there would be expect the British pound sterling to gain strongly against the US dollar over the next few years. But again, we need a timing trigger, and it is absolutely critical. Setup, trigger, and follow through. Within the big picture of things, this is a setup, it's not a trigger. In the Japanese yen, we had a trigger. In cotton, we're waiting for a trigger. Let's go to the next slide. How about this? The cycle in 2-year Treasury note, very interesting. Look at the symmetry. Notice how closely the lows and the highs correlate to the tops and the bottoms. It's not a perfect sine wave cycle, but it is important. And what does it say? The cycle said back in late 2023 to early 2024 that interest rate futures in 2-year note, we're due to bottom. The bottom in futures means higher futures, which means lower interest rates. So we don't need an economist to tell us what to do. In fact, I suggest very strongly we replace most economists with this chart, save the government a lot of money. But remember, this setup required a trigger. That trigger has occurred. Let's go to the next slide. Moment, please. Here we go. How about this one? Soybeans. Basically the same situation in terms of 2 cycles. The bigger cycle, shown in blue for here, also not symmetrical. None of them are symmetrical. Well, every now and then you will find a symmetrical one. But the bottom line is, you will notice, in late 2024 to early 2025, we have a projected cyclical low on both cycles. If you understand the soybean market, you'll know that most soybean markets are down, including soybean meal and soybean oil. Traders are very negative. The news is very negative. Therefore, we can expect a bottom because most bottoms occur on negative news. But we do need one more thing, and that is a timing trigger. One moment, just going to get a drink of water here. Just bear with me, folks. Okay, so this is the soybean picture, expecting the start of a big bull market, which could occur at any time now. All we need, as I said before, is a timing trigger. Super important. We don't trade without triggers. So from the academic standpoint, it's a beautiful picture. There are many things we could do. In other words, we can run through a cyclical analysis program. My circles here are simply visual, not the sophisticated methodologies that the foundation has with Richard Smith and Lars von Tienen. They do a great job, but this is not what I'm doing here. I'm doing simply the bigger picture. And I'm not combining the cycles the way they do electronically. Let's go to the next slide. Going to the next slide, we have this one. What about Bitcoin? This is a weekly chart in Bitcoin futures, as you can see. Again, not perfect, but I want you to notice cyclical low, cyclical high, cyclical bottom, close to a cyclical bottom. And this is not a bottom, but it's the beginning of a move up. What do we do with these? As I said before, important. This is step 1. It's the setup. The setup needs a trigger. The trigger means timing. Timing is what most people use in the form of, for example, divergence, stochastic, RSI, ADX, moving averages, and so forth. So it's a 3-step process: setup, trigger, and follow through. Let me show you what I mean. Step number 1, setup. I will be showing you numerous setups for seasonals and cycles. That step in and of itself is a pattern. The pattern says nothing except that it has predictive validity. It can tell us that something is going to happen in one direction or another, but that setup, of which there are literally thousands, requires a trigger, which most people will call timing. Once we have our timing trigger, we go into step number 3, which is follow through. Follow through consists of 3 parts. Your stop loss, in other words, where are you wrong? Part number 2, where's your first target in which you can take some money off the table and reduce your risk effectively to 0? And number 3, how do you maximize the profit, for which there are specific strategies. So everything is clear and specific, no interpretation. And even though we're waiting for a bottom in a particular market or waiting for a top in a particular market, that bottom or top requires step number 2, trigger. I realize it may sound boring to you, but it's a process. Trading is not an event, it's a process. And if you follow that process, whether you're an investor, whether you're a trader, whether you simply have an academic interest, it will work out for you extremely well, but it must be clear and consistent, and the rules must always be followed. Let's go to the next slide. So seasonality, as we will use it, is defined as the tendency for prices to move in a certain direction at certain times of the year. Example, we know that the first 3 weeks of April have a seasonal tendency for prices to move higher. We know that in late October through November and December, there's a tendency for stock prices to move higher. We know that certain times of the year, grain prices go up between certain dates, They go down between certain dates, and it is our job as researchers to find those relationships. But first, let me give you some backdrop. The reason I want to give you some backdrop is this. The work we do with seasonality is based on a vast amount of data. Most traders and investors these days are willing to look at just a small amount of information. For example, how did this trade do in the last 3 years? That's a wonderful thing. Even if it worked 3 out of 3 times in the last 3 years, statistically, that's not acceptable. What I want is as many years as possible. So, for example, when we study the stock market and determine stock market seasonality, we look at trades that go back over 100 years. And if we get good percentage results, we know we have something that's not a random event, but a fact. And that's super important. Even though we know that facts will not be 100% correct, we do know the odds are in our favor. As an example, looking at the heating oil futures back to 1980, which is a considerable amount of time, and making a chart that shows the behavior of each May futures contract as a normalized chart. Example, we took every year of May heating oil futures and converted it electronically to 100 for the highest price of the year, 0 to the lowest price of the year. And by the way, I should mention at this point, the brains behind creating the website, the application that finds these trades is Dr. Richard Smith, our own Dr. Richard Smith on the foundation board and our chairman or CEO or whatever we call him. But he is the man behind the brains of this. So working with Richard, we developed this website, this application, which you do not need in order to follow our work. Any valid seasonal website, seasonal application should be able to give you this information. So what have we got here? Let me explain it to you. Excuse me. We have a seasonal chart that shows all of the years of May heating oil futures as one chart. As I said before, it's a normalized chart. And we know from looking at this chart that the period of time from the second week of March, let me bring my mouse over there, to the end of April is a period of strength. Prices move higher. The boxes show the percentage of time up or down by week. So what do I know? The seasonality here is very pronounced and very strong. And I want to be a buyer. Start looking for a buy trigger around the first week of March into the second week of March. And so what we've done is we've zeroed in on this territory to find a profitable trade, and we want exact numbers. The only method that I know that gives you everything you need, with one exception, is seasonality. With seasonality, we can determine what to trade or invest in, exactly when to buy, exactly when to sell, exactly how much to risk, when to get in, when to get out, average profit, average loss, average profit in points, average loss in points, average profit in percent, average loss in percent, all of this valuable information, which most methodologies can't even begin to give you because they don't have a record. We keep good records and we keep statistics. All of this is based on statistics. So it's very important to remember, even though it's very high probability, it's not 100%. There's still a risk of loss. Let me show you something else. And again, I may go quickly at the beginning of these sessions, but I will slow down and come back and revisit some of these because these concepts are very powerful. They are, in my view, the most powerful concepts available to traders and investors, and they need to be understanding them. Even if they don't use them for trading, they need to understand what the seasonal is. So, for example, you would not want to be short May heating oil in the month of March because you'd be looking right over here and you'd be heading headlong into a train wreck if you were short the market. So the favorability goes with the seasonal, which is biased to the upside in this case. Some weeks are unpredictable. Some months are unpredictable. That's fine. We are only interested in what's predictable because if it's predictable, we can trade it and invest in it. Let's go to the next slide. So, examples of the kinds of patterns that we have available to us. Chart patterns, retracements, Elliott wave, Fibonacci, seasonality, astrology, etc. All of these are patterns. The good news, as I said before, there are many patterns. The bad news, most of them don't work. They have no predictive validity. And because they have no predictive validity, we have no use for them. We only want patterns that backtest successfully. How do we do that? We have computers. It's very, very simple. So let me show you something else. Let's look at this. I realize that many of you may not trade corn, but I want to give you an example because we have availability of this data for every market, and I will be showing that over the sessions. Example, let's go back in corn prices to 1900, 1890, whatever it is, a considerable period of time. And let's look at this chart right over here. In this chart, we show the percentage of time up or down by month for different times of the year. So this part of the year, January, February, March, April, May, is usually an up time. Going into this part of the year, it's usually a downtime. So the numbers in the boxes represent percentage of time up or down. Example, in the last 115 years, this period of time, the March to May period of time has been an up period. This period of time, toward the end of the year, August, September, has been a down period. We can also statistically measure the number of years up or down, the number of years where we made our high during certain months or low during certain months. Very valuable information for investors and traders, which I will show you how to use in these sessions. Let me show you another one. Here we go. Copper. I'm interested in copper for a particular reason right now, but let me show you something fascinating. And by the way, you'll notice this chart only goes through 2009. If we were to take 1890 to 2023, it would look basically the same as this chart. Why? Because these patterns rarely change over time. They become stable, as you can see. Example, if we take 5 different plots of price for different segments of time, the 11-year segment, 26 years, 51 years, etc., and plot them on a family of curves, they come out to be pretty much the same in terms of trend at different times of the year. A fascinating statistic which you can use for the purpose of investing or trading. So look now, September, October is the period of time where we make lows. What's happening right now? And remember, the data for this year was not included in this chart. This is the current chart of copper. As you can see, it's going down, doing exactly what it should be seasonally. So we're comparing what usually happens, which is the high in April, May, to a downtrend, which is happening now, expecting a bottom in prices, as you can see right over here. So what am I doing with this? Very simple. Think about it. Within the picture, what I've told you, is this a setup, a trigger, or a follow-through? Clearly, it's a setup. Because it's a setup, the setup needs a trigger. So I am looking for a buy trigger in copper. One thing I will tell you is this. I would not want to be short copper at this time of the year because of the fact that it's bottoming and the decline should be mostly over. Look in this box right over here. Look at the percentages. So, example, if you went short copper in August, by the time you got to October, the price would be lower 76% of the time. That's how I use these tables to determine where my strongest moves are going to be in terms of probability of success. Let's look at another chart. Right here. This is a chart that I showed last session. It is the normalized price of the Dow Jones from 1901 all the way through to, let me see just one moment, please, 2017. So remember what I said. The lowest price of the year becomes 0, the highest price of the year becomes 100. So we remove the actual trend and simply show the seasonal pattern, the pure seasonal pattern. The issue is this. What if I looked at the chart now? In other words, including the years that are not shown over here. Here's the chart and what it would look like. As you can see, basically similar. But in addition to that, the chart gives us some very valuable information at the bottom of the screen. And let me explain that information to you. And by the way, don't be concerned. I will be covering all of these features in great detail, session after session. My goal threefold. Number one, to show you how we use seasonal history or seasonal cycles to find winning combinations of trades or investments. Number two, to show you that it's a specific mechanical process. Number three, to show you there is no interpretation whatsoever. We don't interpret anything. We simply look at the numbers, knowing that the numbers will not always give us a winning trade or a winning investment, but we know we'll have a strategy that's clear and specific. So let's check it out. This is not rocket science. Looking at the chart, I see two things that I'm interested in. Actually, I see three. The first one right over here. The first 3 weeks of April showing high probability in the upward direction. I can go to a deeper search and drill down to the exact day that this move begins. And it'll determine for me the percentage of time it was accurate, percentage of time it was a winning probability, or percentage of time it was a losing probability. It can also show me the risk. In addition to that, I see this right over here at the end of the year, from the last week of November until the end of December, a strong, consistent move to the upside in the Dow Jones. But I also see this little one right over here, 2 weeks, 76% and 66% to the upside. Remember what I said. Please always remember what I said about a setup. This chart is a beautiful chart, but it is not a trigger. It doesn't mean that I will definitely buy the Dow Jones the last week of March or the first week of April. It means I will begin to look for a trigger. The trigger needs to be consistent with the market expectation. The market expectation here is up. Therefore, my trigger must be a trigger that will show me an up move when it happens. There are many different triggers, as you know, 2 moving average combinations, 3 moving average combinations. We need to find positive triggers, triggers that are effective, which I will show you in these sessions. And again, my intention here is to educate, not to obfuscate, not to sell you anything, except to give you ideas that will help you in your process to success. Let's go to the next slide. How about this one? Here's the same concept, but rather than going from hold on 1 moment, please. Rather than going from 1910, wait, I'm getting ahead of myself. Okay, so this chart was 1920 to 2018. This chart is 1901 to 2024, containing a considerable amount of more information. So when we expand the history, what happens? These tendencies, which we looked at over here and over here, are still there. What does that mean? What it should mean to you as an investor or a trader is consistency, increased probability of success, a more solid definition, a more solid background, which is what we want. We want clarity and we want specificity. And remember, this is only our first step. Let's go to another one. Here's another one showing just the period of time from 1910 to 1970. So we've taken a 60-year period. And again, you can see the plot, the tendency remains the same across all the years. Let's take a look at this one. H&R blocked. So what we've done now is we've gone to a specific trade. Let me show you what I mean. And again, I want to impress upon you, this is not rocket science. I'm not a mathematician. I'm not an economist. I'm simply a trader or an investor. Let's look at the chart. Let's combine the expected trend with the percentages. I see 2 things on this chart that move me to make a trade. Number 1, this 3-week period over here. Number 2, this 3-week period over here. But remember, in the scheme of things, it is just a setup. I need to dig deeper into this period. I want to find the exact day of the year, day of the month, and so forth. So I do a deeper search, and what I come up with is this. Now, please pay attention. This is not a guarantee, but I want to show you what can happen. When we searched the database in the month of August, right here, to zero in on this trade, this is what we found. We found that historically, buying H&R block end of day August 6th, getting out end of day August 18th, with a 3% stop loss close only gave us 84% probability of success. But I want you to look at the rest of the statistics. They give you everything you need to know with one exception, and that exception is, will it work this year? Do you know of any other methodology that does that? Does your methodology do that? If it doesn't, you might want to do a little bit of investigation and determine how you can get that information. Very, very simple. So what happened? Remember, this is a trade that we knew before it happened. No guarantee, because after all, 84% accuracy is clearly not 100%. This is a chart of the historical performance of this trade, the cumulative result, and the yearly result 1 year at a time. You can see that for the last 2 years, it did extremely well. The average trader would look at this individual trade and say, it's been working too well. It can't possibly continue. We don't do that. We look at it and ask the question, this is a setup. It requires a trigger. And what we have found is this. Those seasonal patterns that have 80% probability or higher historically generally don't do any better with the trigger and usually don't need one. In fact, sometimes the trigger will keep you out of a trade like this. So let's see what actually happened. Here's the chart of what actually happened. This was the entry date. This was the exit date. The trade was over. And if you wanted to, you could keep part of your position and trail a stop. Very simple. Now, I hasten to add, they won't all be this beautiful. They won't all be this pretty. They all involve a certain amount of risk. But again, there are ways to manage that risk and mitigate that risk. And we know what those are. Options, option strategy, etc. We'll dig into those details later because after all, we want to look at this methodology in two ways. The academic way, by which I mean, gee, isn't this wonderful that markets repeat, that there are cyclical patterns within the year called seasonals? Or number two, wow, this is fantastic. This is a way for me to trade. Or you can wear both hats at the same time. And by the way, should you have any questions, please don't hesitate to send them to me at the foundation, and I will answer them as best I can. So let me show you something else. If I go to this website, Seasonal Trader, and this is not a promo for Seasonal Trader. This is the website, by the way, the application that Dr. Smith did so beautifully for me. If we search coffee and we go to the details, we find this particular chart. Remember what I said. And even if you're not a coffee trader, we also look at stocks as well. There are many stocks to look at, but it's just an example. The chart is not rocket science. Remember what I said. We're looking for moves in the same direction over an extended period of time. And here is that move right over here. Down with high probability of success. So remember what I said before, excuse me, within the context of what we do. Is this a setup, a trigger, or a follow-through? It's a setup. We haven't even started to look at triggers yet, which we will do in future sessions. If we go to the computer, we do a deep search, we can find this trade very clearly on the computer. And this is how it performed a few years ago. And I will be showing many of these trades year after year after year, showing you their performance. No guarantees. Now let's look at this chart. Again, given the quote-unquote education or brainwashing that I've been trying to do with you for the last half hour or so, look at the chart. Think about this before you say anything. I'll give you the answer momentarily. Do you see anything here that captures your attention as a potential trade or investment? I do. I see this little one to the downside right over here. But I see this right over here. And what does this tell me? It says that for this stock, Alcoa, from 1970 through 2023, even though I have 2024 on here, it's not included in the data. What is the biggest move we could get? The biggest move of the entire year tends to begin in mid-November and continue till the end of the year. The probabilities are very high and the magnitude is very big as well. So what it says is this: if you have a timing trigger to buy Alcoa second week of November on a specific date, which we can find through a search, and if that trade triggers, you can expect a sizable up move. How sizable? Interesting. Let me show you something. Let's go back to the block trade. You will notice the block trade, H&R block, gives us a percentage average profit, a percentage average loss, the stop loss, and so forth. And that's where the information will come from to give you the profit potential target and so forth. So it's a combined strategy: setup, trigger, and follow through. Let me go further with this before we run out of time. Just bear with me, folks. So here we go. We took this Alcoa situation and we did a search. So we drilled down into a deeper level of specificity, the daily chart. By going to the computer, we asked the question: for Alcoa, for the month of November through January of next year, have there been any trades that have high probability of success? The computer comes back and gives us this trade at the top of the list. In fact, it gave us about 7 pages of trades. Let me take a look. One moment, please. It gave us 78 pages of trades. And so what it says is this. It says 83% of the time, the closing price of Alcoa on January the 5th has been higher than it was on November the 20th without having gone down against you by 12% on a closing basis. So it gives me the stop, the profit target, the entry date, the exit date, everything I need, including all the performance statistics historically. And remember, the future may give us an idea. The past may give us an idea of the future, but it is never 100%. So please bear that in mind. There's always a risk in this, and in this case, the risk is 12%, but the probability of success is very high. So let me do a couple of more things before we run out of time. I think I'm allocated for 45 minutes, and it has been about 40 minutes, maybe 35 minutes. In addition to that, we can look at the entire history of this trade, year after year after year. And do note, the trade we're looking at for Alcoa goes back 54 years. Stop and think about that, ladies and gentlemen. Does the methodology that you're using give you history back 54 years, showing you exactly what would have happened or what could have happened? Does it give you exact entry and exit? Seasonality can do that for us. And as I said before, 2 levels. The academic level, which is, wow, this is a strong testimonial to the existence of patterns and cycles. And number 2, wow, this is an incredible way to trade. Will it always be right? Of course not. But combined with the methodology, setup, trigger, and follow through, that's where we get our results. Let's see what else I've got for you today. This is the performance history of the Alcoa trade. And let's remember setup, trigger, and follow through. And let's go to one more. And that's the pre-holiday seasonality. Many of you may be familiar with the book by Arthur Merrill called The Behavior of Prices on Wall Street. If you haven't seen the book, I strongly suggest you get it. It's out of print, so you'd have to buy a used copy. What Merrill said is very simple and very direct. He studied all legal U.S. holidays. And let me see if I have a list of them for you. Yes. And he showed that on the day before legal U.S. holidays, the Dow Jones Industrial Average tended to close higher. As an example, let's take the most recent trade. Monday, September 2nd, Labor Day this year. Because Labor Day is on a Monday, the strategy based on Merrill's work would be to buy Dow Jones or equivalent at the end of the day, Thursday. In studying this pattern, Merrill concluded the probability of this being a random event was 1 in 10,000. In other words, it is a fact, not a random event. If you take a look at the pattern this year, or if you look at the Memorial Day pattern this year, or you look at the New Year's Day pattern, or you look at the Independence Day pattern, you will find that all of them worked exactly according to the rules. But remember, within the context of what we do, we want to have setup, trigger, and follow through. So it's one thing to have the data. It's another thing to use it correctly. Let's look at one more thing. We can go to our seasonal search program and ask the question, is it possible that these dates are significant in terms of giving you an opportunity to get in before the holiday? In other words, is it possible that sometime in late August, there would be a turn to the upside rather than having to wait until the last day, as according to the rules? In other words, is there a spread of effect? Do these trades begin to move up sooner than that? Very easy. We can find them very simply. Let me show you what I mean. If we search for the trades like so, example, searching the July holiday, July the 5th, July the 4th holiday. We go to the computer and the computer finds us a trade that begins before that. It actually begins on June 28th and runs until July 22nd, giving us a higher average profit and a very strong probability of success right over here at 76% success. So remember what I said, setup, trigger, follow through. Here's that trade that we found. And again, I want you to look at it and try thinking out of the box, by which I mean, look, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 years in a row, this trade was profitable. The average individual might be thinking, it's done too well. It can't possibly work this year. After all, we've got the war in Ukraine. We've got the war in the Middle East. We've got North Korea rattling their sabers again. We've got Iran. We've got Iraq. We've got all these problems. It can't possibly work. Well, guess what? Challenge you to take a look and see for yourself. What happened to this trade? What if you bought this trade end of day, June 28th, and got out July 22nd and used this right over here as your first profit target, percent average profit? Check it out, and we'll cover this again in the next session. So let me review for you what we did today. We looked at the concept of seasonality, and please pardon the voice. It'll be back by next time. We looked at the concept of seasonality as a setup. We showed you that seasonality is a cyclical pattern that occurs within the course of a year. There are short-term seasonals, which last a few days. There are longer-term seasonals, which last a few weeks or a few months. There are seasonals in cash markets, which we looked at. There are seasonals in futures. There are seasonals in stocks. In addition to that, in these sessions, we will look at seasonal spread relationships. We will look at ultra short-term seasonals. We will also look at how does seasonality affect the intraday behavior of stocks and futures. So that's what we're going to be looking at. So I want to thank you for being here today. Please drop me a line. Please click the like button if you liked what I said. If you didn't like what I said, I'm sorry. Remember, the price was right. Thank you, everyone, for being here. Have a wonderful weekend.